In this video, we will look at how to record non-cash contributions for Year 12 accounting. The first thing we need to know is the kind of source document that is used. So these are called memos, and you can see the definition at the top of the screen there. So we've already looked at lots of different kinds of source documents. We've got receipts, check butts, we've got bank statements, we've got EFTPOS transactions, invoices. Memos are a special kind of source document that reference a transaction that happens internally or within the business. And often they're used to verify transactions that don't involve cash or are not related to sales, purchases, or returns of inventory. So they kind of cover a range of things that fit into the other category. So in Chapter 7 of our text, we're going to look at 4 different kinds of transactions that are all verified by memos. So there'll be 4 different videos that you can watch to have a look at how we record these. The first one we're going to have a look at is a non-cash contribution. So you can see here we've got a scenario on the left-hand side where a business sells exclusive baseball caps and snapbacks featuring sports teams from all over the world. On April 9, they set up a new store in Dandenong and they contributed a personal computer system to the business. So this was purchased in 2019 for $4,800 plus GST, but had a fair value of $3,750. So before we even get into the recording, we need to have an understanding of what this word or this concept of fair value means. So fair value is the price of an asset at the time it was contributed to the business. So the way we think about it is how much would we be able to sell this asset for at the time the business acquires or gets that asset. The reason why we use fair value, which essentially is an estimate of the asset's market value at the time, is because we know that the asset's value will not necessarily still be how much we paid for it originally, because we might have used some of the benefit or consumed some of that before it came to the business itself. So using fair value supports the idea that we've got accurate information or more accurate information going into our records. It also supports the assumption of entity, where we are recording the contribution of assets from the owner to the business because we're treating them as separate legal entities. But one of the issues or the problems of using fair value is that it can bring up some concerns around verifiability or faithful representation. And that's because there's no real source documents that verify fair value. It's really an estimate, and inaccurate valuations could lead to issues with things like relevance. So there's always some ethical considerations about making sure that when you are using fair value, which we really should be, that you are estimating with good information. So an example might be that you get it valued by a professional, or you might use a couple of different sources to get that valuation, maybe like an online source. So knowing that, we are going to contribute this computer system at the fair value of $3,750, not at the original purchase price, because that was the original purchase price for the owner, not for the business. So to record this in our general journal, we'll need to record that on April 9, we had a computer, so we know that a computer is a form of asset, and that asset is going to be increasing. So I'm going to debit that $3,750. Now the second account, I know that I'm going to have to credit by that same amount because debits have to equal credits. And the second account affected is going to be my capital account. So the owner is putting things into the business, therefore my capital is going to increase. Now when I look at this next part, I have to do a narration. So my narration is just an explanation of what this transaction is. So I could simply say, owner contributed own computer at fair value. So I'm saying what was contributed and what was the valuation that was used. And of course I'm going to put my source document as evidence, so memo 12. So that's going to occur on April 9. I've got my debits and my credits. And then if I was going to be transferring that down into my general ledger, I would be affecting the computer and the capital accounts, and they would look like this. So in the computer account, that is going to be debited, and the cross-reference, or its friend, is going to be capital. Over in the capital account, the cross-reference is going to be computer, and those are my amounts. So lastly, if we look at the effect on the accounting equation, we can see from my general journal that I've got an asset and I've got owner's equity. So straight away I can see that there's no effect on liabilities. So I simply write no effect and then put a dash or a 0 in the amount column. I can see that a computer is an asset, and that has increased by 3,750, and my owner's equity has increased by the same amount. So I can see from here that my equation is balanced because my assets are equaling my liabilities plus owner's equity. Therefore, I know that I've recorded this correctly.